Hello, and welcome to Fireside with a VC. My name is Andrew Romans, and today we're going to talk about fund of funds, or FOF. And fund of funds invest into venture capital funds, and so part of this industry is you've got to get your money from somewhere, and fund of funds are a great place to get it. So I'm very excited to welcome André Jaeggi to talk to us today. André joined Bruno Raschel 3 months after he founded Adveq. And together they built Adveq into I believe, a $10 billion plus fund of funds. Is that right, Andre?
That's correct.
So, Andre, why don't we just jump right into things? Andre, what is a fund of funds? And maybe help us define what it is and maybe why do they even exist?
Well, in simple words, a fund of fund is a ready-made portfolio of a specific asset class, in this case, venture capital, for an investor who does not have the resources, either in terms of size, money at hand, or in terms of infrastructure, personal resources, to build up this portfolio himself. So let's take, just as an illustration, I mean, if you want to build a venture portfolio over, let's say, 3 years, you need to be able to put chunks of 5 to 10 million each. So you need at least to be able to deploy 60 to 80 millions in order to get there. And you need resources in terms of infrastructure, but also in terms of people, in order to make your due diligence, to deploy the money, to manage the relationships, and on and on. So at the onset, for an investor using a fund of fund, there is always a decision to outsource a very specific service, in that case, to a fund of fund manager.
Yeah, it's interesting because sometimes you meet someone who's worth 1.4 billion on the Forbes list, but what percentage of that are they putting into the alternative asset class, and then how are they situated wherever they are in the world to do that? Now, Andre, you're based in Zurich. Where have you historically deployed most of your capital on a global basis?
Historically, on a global base, we have deployed the majority of the money in the US, at least as long as it goes to the venture space. On the buyout side, it's a bit different, but in the venture space, it's clearly the US. The reason for that is when we began Adveq, we had an extremely solid relationship on the West Coast with, first of all, the then already late treasurer of Stanford University, but also with Bert Jamieson, who was the founder of Sigma Partners, or one of the founders of Sigma Partners. So through these relationships, we got access to some of the very best venture funds on the West Coast. And on the East Coast, we had a very long lasting relationship with Alan Buffett, who was at the time treasurer of the MIT. And thanks to his network, we were able to access some of the top tier funds on the East side. So that's really where we placed the money. And we did that on behalf of Swiss, German, and Austrian at the beginning institutional investors, pension funds to start with, but then also insurance companies, and gradually grew this base of investors into the Benelux countries, into the UK, into the Nordic countries. But that's basically how it started.
Yeah. So you have an interesting bird's eye view of venture capital over different geographies and over a broad period of time. The ecosystem in Silicon Valley is just so much further evolved than in other places where there's an investor at every stage that helps the company prevent from running out of capital at the startup level. And then there's a lot of big balance sheet buyers. At the same time, it could be a little crowded. There's a lot of VCs competing to get into the same deals. What's your perspective over this period of decades of how venture capital on the East Coast versus the US have evolved? And then we could talk about Europe and international.
Well, the interesting thing has always been that if you think of some of the very best brand names, these guys have managed to stay on top of the curve over almost decades. You have, long-lasting names who even have, built generations of venture capitalists in the States, and managed to be really top of the team, fund after fund after fund after fund. So if you have access to these guys, obviously you tend to stay with them.
Right.
Having said that, I mean, as a fund of funds, you are not selling or trying not selling a black box, but as much as possible, you're trying to sell a portfolio of existing relationships.
Right.
So don't change too much of it, because your end investors want to know, well, what are the names you will be investing in over the period of the next fund of funds, which usually is 2.5 to 3.5 years, something like that. So at least 2/3 of your relationship in the portfolio should be stable.
Right. It's interesting. Sometimes you see a VC trying to raise a VC fund, trying to warehouse, which is the term, warehouse an allocation into a few startups. But I worry about that because good startups are moving so quickly in closing their financing rounds that you don't have a lot of time to build a portfolio in warehouse. Whereas at the fund of funds level, with the VC raising a fund over a 2-3 year pace of a new fund every 2 or 3 years, there is perhaps time to get in discussions with, say, maybe 10 funds, warehouse an allocation to those 10, market that fund of funds, and then add another maybe 1/3 to it. What's your perspective on in 2001 and 2008, we had these big economic downturns, and it appeared to me that the VC asset class emerged with larger funds. So if you had past performance, you went from a $250 million fund to a $750 million fund, or even a $1.2 billion fund. So you guys probably witnessed the size of a single VC fund grow. What's your perspective on, the evolution of VC funds going from a bit smaller in size to much bigger and having to write different checks or having new strategies?
Well, that's correct, but you have to be a bit careful, because when you build a portfolio as a fund of funds, as said, you have probably 2/3 of your relationships which are almost a given. There you have to be careful just about keeping your allocations correct. But at the same time, you always want to add some new names, because there will be dropouts on the other side. So you want to add some new names. And these new names, by definition, will raise rather smallish funds, or smaller funds, I should say. And at the same time, you want every fund that you have in your fund of fund to have an impact on your portfolio. And having an impact means that you do not want to dilute the results of any specific fund by having too much size under management. And that gives you an element of quality into the fund of funds, which you don't have if you just follow the size.
Right.
So again, to give you an illustration, let's assume you get a 10 million allocation of fund A. If you put this 10 million into a fund of a 250 million size, there may be a certain impact if the performance is very good. If the performance is stellar, the impact obviously will be limited if you have a 5 million vehicle instead of that. So right. You have to be very careful to match the amount, the allocations you get with the total size of your fund of funds. Otherwise, you become just an asset gatherer, and you expose yourself to the risk that one of the VC funds you invest with tell you, well, look, you have become an asset gatherer. You just use our name as a marketing gimmick, and as a consequence, we throw you out. That's, for instance, the standpoint that Sequoia has taken at a given point in time, just throwing out all fund of funds because many of them had become asset gatherers. In hindsight, of course, we were angry when it happened, but in hindsight, I have to say they were right, because most fund of funds had become asset gatherer at that time, just looking to maximize their own management fee and don't caring about the performance fee anymore.
So the asset gatherer, it's clear on the venture side, they're saying you're just using my name as Sequoia or someone else and running around the earth and going to endowments and pension funds and not necessarily adding value into the system. How do you break free of being an asset gatherer? How can you be a value adding, actor within the ecosystem?
Well, two elements. The first, and probably the most important one, is by, charging a management fee which covers your cost base. Obviously, that's a must. But at the same time, was really concentrating on a performance fee which is worth the name performance fee, meaning try to have a solid hurdle rate in order of that, and make sure that your performance fee really also makes an impact for yourself as a fund manager, and give your own investors the security that you are really caring about the performance and not just caring about the management fee. That's one element. But the other element is then making sure and that the VC funds you invest with get some additional value add. And that's something that we, in our case, were not able to do from the very onset. But over time, when we really had a relationship of with global VC funds, you could bring together different funds which had no idea of each other. Here again, an illustration. We had in our Asian VC portfolio at the given time, we had a Japanese investee company in a fund, which was one of the first ones to provide LED displays on the facade of a building.
Oh, yeah, sure.
At the same time, we had in our European buyout portfolio, we had a relationship with a fund who had an investee company which was building glass facades. So you bring the two together, and as a matter of fact, they were able to have a first pilot project on one of the high rises in Tokyo, and a whole relationship started out of this. And that's where you can then persuade the funds you invest with that you're not just bringing money, but that you are from time to time at least also adding some value.
Well, full disclosure for those listening, Andre, you're an LP in all three of my VC funds and over a period of many years. And I think, the network you've brought to us and participating at our events has been fantastic. So I think the value of that network is huge. Which one of the questions I wanted to ask you is if you're a VC seeking to raise LP capital, with all the kind of typical backers of the asset class, what do you think VCs should be shooting for? What's the ideal LP for a venture capital fund?
That's a tough one. Let me first just make a side remark. I invested in your funds as an individual and not at my time as a fund of fund manager. So let's be clear about that.
Okay.
Well, what kind of LP should the VC shoot for? First of all, one who has the understanding for the needs of the industry also in a downturn. It's always in a downturn that you make friends. You don't make friends in an upturn when everything is going fine. Who has an understanding for that perhaps in difficult times, sometimes you need additional money. You need to refund certain companies. You need also to cut off certain companies at the given time, and that sometimes it needs a bit more time to develop. So what you need is an LP who is shooting for multiples and not necessarily for an IRR. That's the case for a fund of fund, obviously, but it's also the case for a pension fund. A pension fund pays rents out of a multiple and not out of an IRR. Let's be very clear about that. The same is true for an endowment. Even if you have a stellar IRR and the holding period, which is just 2 or 3 months, that's absolute nonsense, because in terms of multiple, you don't pay anything with that. It looks good. It looks good, but in terms of cash on cash returns, it doesn't mean too much. So, these type of elements. And then what you also want to have is an LP who can perhaps, if needed, give you some guidance, open some doors, and is willing to stay for the long term and to build a long-term relationship.
And this may be a boring, obvious question, but what are the key characteristics you look for when doing manager selection and deciding which venture capital fund to invest in?
Oh, we had a whole series of factors we were looking for. Without going into too many details, we had a series of indicators for potential performance, but also for potential risks. And what I can tell you is that past performance was only a very minor factor,
really,
in the whole equation. We were also looking for soft factors. I mean,
what have you seen with generational transformation? I mean, some of these companies like Sequoia, and Dick Kramlich founded NEA in '73 or something. Have you seen generational transfer be successful? I guess in some cases yes, in some cases no.
We have seen very successful ones. We have seen very successful ones, but these were usually the ones where the handover was made very gradually and in a very smooth way. Some have been extremely successful in doing that, and others just fell apart when the generational transition came. I mean, that's something that happens in the VC world. It happens in the buyout world. Take the Adveq example. I mean, you mentioned Bruno Rashley and myself. I mean, we were the two initial partners. We tried to add partners at the given point in time. It didn't work out. So, you go back to the drawing board and plan your succession differently. It's a long process which needs to ensure that a given fund manager really is able to hand over almost his DNA to the new guys. And that's usually luck plays a role in that. Let's be very clear.
But the gradual makes more sense. When you're working with somebody, day after day and year after year, you begin to kind of shape into one way of thinking, and you're learning from the same mistakes. So when something else happens, you both live through that other experience, you're going to respond to it in a similar way. So I think that, a forklift change is probably bad, and the gradually adding and harmonizing and then changing the people is probably, that smooth thing is real, for sure. And talk a little bit about on the international, you guys, I think, were one of the first renminbi, an RMB based fund. What happened with China, Andre? When did you go into China with Adveq?
We made the first investment in a Greater China fund in '98. That was a Hong Kong-based fund at the time, but already investing in Chinese mainland. So that allowed us very early on to make certain inroads into Chinese mainland, and then gradually you develop relationship, and then you take a foothold. We took 2 footholds, as a matter of fact, one in Shanghai, the other one in Beijing. And then you gradually build up relationship. relationships, and then we were the first fund of funds to get a license in Shanghai, which allowed us to gather for Chinese money, and that's how the whole thing started. But having said that, what you have to keep in mind, it was an extremely lengthy process. In China, you need more stamina than in any other place. We were lucky to be in a position where we had two main partners, Bruno and I, who had the majority of the firm and who said, okay, for us, it's an investment and we are willing to wait 4 years, 5 years, 6 years until we see a return on that investment. That's what happened. That's the time horizon we needed to have there. Now, since we have sold Adveq to Schroders 3 years ago, they have continued to develop that. It works out quite well what they are doing currently in China. I'm pleased to see how they behave. I'm pleased to see what comes out of it in terms of return. But you have to be prepared for an extremely long time in a country like that.
Yeah, I think patience and persistence and being able to handle frustration calmly, are winning characteristics for that region. What
well, handling frustration is something you have to be willing as soon as you touch venture capital.
Yeah, right. I mean, I've seen other VCs investing with us over the years getting emotional about turbulence at the startup level. And I'm thinking, man, this is some percentage of your fund at all times. There's choppy water every day in this business. I mean, if you're not, built for that, then this is not your sport. But what do you think? I mean, Silicon Valley obviously is really taken off, but, and when I was a young entrepreneur, you might have thought the money was in New York, but the money was in Boston. When I was in Washington, D.C., we had to go up to Boston to meet real VCs. And then, of course, New York blew up with lots of VCs in the late 90s, and then they all disappeared in early 2000s. And now we seem to have a sustained ecosystem there. But with other ecosystems like Berlin, London, France, with huge government money going in as well, with BPI France, European Investment Fund, British Business Bank, tripling its budget after Brexit. Do you think we're going to hit a steady state of the volumes of venture capital in different countries, or do you think we're right at the beginning? What do you predict is going to happen kind of on a global basis?
Oh, I don't have a crystal ball, but what I can see is if you look at these different ecosystems, I do not know for certain that they are really separate ecosystems, because if you look at the guys who are active in all regions of the world, they are very well networked with each other. That's why I'm saying the ecosystem is not so separate.
I mean,
the ground level, there is a global network going on, which in my opinion at least is here to stay.
I mean, I would agree extremely, because part of what I think we do is the fact that we know all these VCs, we're able to show them our portfolio companies, and they know us going back a long time, and get them to invest in our companies at higher valuations with more capital and bring those networks. And likewise, if we meet with them and see one of their portfolio companies, and we have a unique relationship in Tokyo with the glass on the side of a building or something like that, we earn a seat at the table to syndicate and add value. I think syndication is pretty important here. Well, Andre, talk a little bit about what you believe is attractive about the asset class, and then even how you've seen the venture asset class perform in boom cycles and economic downturns. I think we're probably going through a W curve right now with coming out of COVID, and we're talking here and drifting into the middle of June of 2020. But what is it about the venture capital asset class that you think has value in it?
Well, the venture asset class, by definition, is concentrating on new things. New things in terms of new technologies, new things in terms of life sciences, new things in terms of medical devices, but also new things in terms of new marketing possibilities that are coming up, or new communities you can market to. And as a consequence of this, by definition, the venture industry is concentrating on new things, and who says new says growth. So if an investor is looking for growth and has the time to wait, venture capital is by definition the most attractive space to be. Now, of course, it comes in cycles, but having said that, a good company is going to be acquired in good times and in bad times. Perhaps even more in bad times, because some bigger company has an issue to solve, and it can solve it by acquiring a young startup which is doing something that nobody had the idea of instead of this startup. I mean, you see that in the whole sharing community, or in the whole home delivery community that is active right now. So, venture capital, if an investor has time to wait, it's a place to be. Don't bet too much of the house of it, but at least a big part of the house you can bet on.
And maybe some closing thoughts. There's always the supply of money going into the venture capital system, and I think some of these numbers get a little bit warped when you see post Sarbanes-Oxley startups not IPOing and staying private while achieving $70 billion valuations. In the old days, you go public and you were happy to have a $300 million valuation on the NASDAQ. Whereas now, what is venture capital and what should have been, IPOs. So it's kind of hard to define. But do you think that the amount of capital in the system is right sized, or do you think it's going to increase or decrease over the next 10, 20 years?
Again, I don't have any crystal ball. It's obvious that right now you have a lot of money in the system, and perhaps I should even say you have a lot of dumb money in the system, which is never a good thing. You have greed in the system. When you see these fantastic IPOs that have happened in 2018, 2019, and you can consider it as crazy. Maybe it is crazy, I don't know. Some of these numbers have deflated recently, which is probably a something. Greed usually is not the best advisor you can have. What I am personally concentrating on is building good and solid companies. And when I see that, I'm happy with the return, even if that return is not the very best. What I'm meaning by that is, as an investor in a fund of funds, acting on behalf of pension funds and insurance companies. So don't forget, that's the money of the small man at the end of the day. If they get something like 3-4x, that's perfect. If they have a 10x once in a while, okay, that's fine. Let's grab it. Let's take it. But don't get too greedy. That's my advice to you as a venture capitalist. Build solid firms. If you build solid firms in attractive spaces, you will find a buyer, be it via IPO, be it via M&A. The solidity and the uniqueness of your investee companies, that's what makes the difference. In terms of valuation, I'd rather rest my case. I mean, we've seen crazy things. Are they here to stay? I have no idea, honestly.
Yeah. I think that in these economic downturns, the very early stage has it the hardest to, attract that next investor. Although in certain places of the world, the money is consistently there. Valuations have definitely come down there. In the companies with traction that are growing, in some ways, COVID is an accelerant. We've seen some companies hit hard and others benefiting. I mean, Walmart announced a 74% increase in online sales, not surprising. And that's sort of the same effect for a lot of other companies. I think that in that early stage where companies are growing to 10, 20, 30, 50 million in revenue, the market to me looks very sane. When you see the pre-IPO phenomenon area where you've got these structured deals that'll say, you tell me any valuation you want, and I'll give you the terms of me getting a 3x return before sharing money with the seller. Those valuations were so structured that by the time it converts to one common shares in an IPO, that's a real moment of reckoning, I think, to clean out all of that structured stuff that was negotiated. And it's hard for even public market people to understand what those trading deals were as they hit that 80 billion point mark.
Sure, and at the same time, don't forget that historically, some of the very best companies have received their first funding in the downturns, be it when the dot-com bubble burst, or be it in 2008, if you think of some fintech companies, if you think of 2000, 2001, take the Googles of this world. I mean, usually the best investments are made in downturns. As a consequence, today is probably a perfect period to invest into venture capital.
Well, I don't think we can close on a better note than that.
Today, but it's certainly the safer way to invest today than it was in 2018.
Yeah, I mean, valuations are more sane. The startups are all adopted a culture of austerity as opposed to talent war justifies Michelin star chef and everyone Ubers home every night. So spending at the startup level is much more sane. I think investors are looking for real value as opposed to try to get rich quick on some kind of hysteria. And we're not day traders. So if we hold our assets for 2, 3, 5, 7, 9 years, you could expect to exit in a healthy life cycle. So lower entry points, more austerity, focus on value rather than hype. These are, sane things. I once heard Bill Draper say, we were sitting at some event and someone was talking about, are we in a bubble? Are we in a bubble? And everyone's saying, are we in a bubble? And Bill says, I don't care. I made a lot of money in a bubble and I made a lot of money in a downturn.
Correct.
And so I thought that was good advice. But André, I'll let you get into your Friday evening over there in Switzerland. Thank you so much for joining us, and hope to see you soon in person when this international travel becomes more normal.
Hope so. See
okay.
you soon.
Thank you so much.
Thanks.
Bye for now.